the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, friend. I've got a question.
Answered.
We love getting community questions in, and today we have one that is coming from Prasad, so let's give it a listen.
Okay, guys, I'm Prasad. I started listening to you guys recently. What do you thought about having gold ETF on your core portfolio? Because some people saying it's going to go down this year. Just want to know what you thought.
Love it. Thank you so much for the question, Prasad. A reminder that if you'd like to ask us a question and get on the show, there will be a link in the show notes or description for you to leave us a voicemail, or you can send us an email, whatever you would prefer. So, yes, Prasad, gold. Great question. Let's start with the performance of gold because goodness me, it's been going well. The last 12 months, gold in Australian dollars is up 43%. It's now about $4,500 an ounce. Gold in US dollars is up about 38%. It's about $2,800 an ounce.
Yes.
Now to, I guess, cover off the question from Prasad around expectations, had a bit of a look online, and analyst expectations do vary. UBS has it as low as $2,600 for the year. Bank of America as high as $3,000. Not a huge spread considering it's at about $2,800, but definitely I would call that sort of flat.
Yeah, or from here. It's had an incredible run.
Yeah.
So the question isn't how's it going to go this year. If you're thinking about adding a gold ETF to your core portfolio, you really have to think about it longer term. And we can talk a little bit about some longer term performance of gold in a second. But if we keep it, I guess, theoretical, the reason you would have it in your core portfolio is it diversifies your portfolio. Like it has low correlation to some of the other assets in your core portfolio, namely stocks.
Yeah.
Store of wealth and hedge against inflation.
Yeah.
So as the currency inflates and gets worth less, gold it has traditionally been a good store of value.
Yeah.
So that's why you would have it in there. But let's call a spade a spade. Why you have it in there is because you want it to grow over time.
Yeah, you want to make money.
That's why you have a portfolio.
Yeah.
And I came across these numbers that I think illustrate how gold has gone historically.
Okay.
Past 20 years.
Nice.
From 22 years. In 2003, gold was, in Australian dollars, $500 an ounce. In 2025, gold is $4,400 an ounce. So that's up about 800% in that time. Pretty good.
Pretty good, yeah.
But investing is a relative game.
That's true.
And it's not about how something has grown in isolation. It's about how something has grown relative to all my other options.
Yeah.
So if we stay in Australia, last 22 years, what asset would we have loved to have been in?
Property.
And more specifically?
Residential property.
And more specifically?
Sydney residential property.
Okay, so let's compare the pair. So gold went from, in 2003, gold was $500 an ounce. The median house price in Sydney was $500,000.
Wow.
Now gold is $4,400 an ounce.
Mm-hmm.
The Sydney median house price is $1.7 million. So gold is up 800%. The Sydney median house price is up 240%. So gold has outperformed Sydney house prices. Put another way, Sydney house prices are actually down 60% in gold terms since 2003.
Yeah.
Now, for context, wages in that time, I think, are up about 100%.
Okay.
So wages haven't kept up with any investable assets, which is why you need to put your money to work, which is why you need to invest. Now, property bulls are sitting here and listening to us and saying, yeah, but you don't get the tax benefits or the leverage with gold that you do with housing. Sure, but on an asset-to-asset basis, just comparing the pair, gold has done well.
Love it. Well, if gold does well and we know theoretically why it should be in our portfolios, the question is then, well, how much should I be allocating into my portfolio? Again, from everything that we've learned on the show, generally 5 to 10% is a rule of thumb if you want to have an allocation to gold.
Yeah.
Like it's your traditional, like not defensive play, but for all the reasons you said, diversification, store of wealth, like it can just sit there and do its thing. I mean, it has almost 10 bags in 20 years, so we can't say it's not going to deliver you the returns compared to some of the big tech names, but 5 to 10% is generally how we see it in a lot of portfolios.
Yeah. So there's a few options when it comes to gold ETFs. The most important thing is you understand the gold ETF you're buying. Because there's three categories. There's synthetic gold ETFs, which track the gold price using financial instruments. Then there's physical gold ETFs, which actually own the gold. And then there's gold company or gold miner ETFs that you'll see. And they all are quite different. Like they all will be correlated to the gold price. But for us, you want to have if you want to track the gold price, track the gold price. And you want to own an ETF that actually owns physical gold. The reason that gold miners, they're more of a leverage bet on the gold price, but there's just risk that comes in with that. Like there's risk with the mining industry, or there's, there could be company tax changes, or there's just companies could go bust. And it's like, you just, if you want the price of gold, track the price of gold.
Yes.
Yeah.
So to do that, there are three that we've come across here in Australia. If you're overseas, make sure you look for the equivalents. There's the Global X Physical Gold ETF. The ticker is ASX Gold. I think it's the largest in Australia. It tracks the spot price. It's backed by gold sitting in a vault over in London. It's unhedged and has a management fee of 0.4%. Then there's the Perth Mint Gold. Its ticker is PM Gold. Again, tracks international gold price, backed by gold bullion that is stored in the Perth Mint with a government guarantee, and it has the lowest management fee among ASX listed gold ETFs of 0.15%. And then there's the BetaShares Gold Bullion ETF. It is currency hedged. Its ticker is QAU, again backed by gold, hedged in AUD to minimize currency risk. And yeah, they've got vaults. I'm not sure where they are, but there is actual gold sitting in a vault somewhere. Yeah. So that's what we mean. There's literally gold sitting somewhere back in these ETFs.
So QAU is also in London in a JP Morgan Chase vault.
Nice.
It has the highest management fee of the three, 0.59%. But BetaShares would say, well, the additional management fee is for the currency hedging. Yeah. So it's just, do you want it hedged or unhedged? We've done content on choices around hedged or unhedged ETFs that you can find in our back catalogue if you want to think about that choice. Final question for you, Bryce, as we close out this gold conversation. Do you own any in your portfolio?
No, I used to own gold, the Global X. I don't anymore. Feel like I just wanted to go all in on equities. That's the only reason. Has
this conversation changed your thinking on that?
I mean, I always toss and turn about it, yeah. But then I always, to your point, find myself going, 5% in gold, or all the other tantalizing stocks that we spoke about at the top of the episode. Do you know what I mean? I just come to that like point where it's like, if I'm going to put my money to work, is it gold? Those numbers have really helped me though. Like I didn't realize that over that 20-year period, it's done so well. But yeah, what about you?
I don't. It is interesting, and maybe I will at some point, but right now, I'm pretty happy with where I'm at with my investments.
Good segue though, because I tell you what I do have is a gold mineral explorations company in the 500 to 5,000 challenge.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful. Equity.